So we decided to do something a little bit differently this week. We wanted to do something fun, and so we're having coffee with Chris, and we are going to interrogate Chris, and we're going to grill Chris on some questions that we've been getting, and let's see how he handles these questions. So my question is, if I was an investor, should I have stayed invested in the market through all this turmoil and all this volatility just to get back to basically almost zero? If the market was down, let's say 30-ish% and it's up 50-ish%, well then maybe I got back to zero, or maybe I just barely made a little bit of money. Was it worth the risk?
It's a lot of questions in there, Dave. So first off, I think that depends on your philosophy and what are you trying to achieve. And so if you have a long time frame and you're not taking an income out, yes, that philosophy can work just fine. And over long periods of time, that type of passive investing with a good, well-built model works well. I think that in this case, when we ask a question like that, we're all humans, so we all have a tendency to do that. We have two things working against us. One, we know what happens in the past. So when it sells off in March, we know that it rebounds in April and May. When it levels out in June, it goes on a run in August. So we're getting the benefit of hindsight being 20/20. And we're also looking at this really narrow time frame, and which then makes us kind of myopic, and it kind of causes us to forget what our long-term goals are. And so what you really just described is a zero-sum game where you took a lot of risk and you gained nothing. And that's maybe that's not the traditional definition of a zero-sum game, but you still took a lot of risk in that downturn to only get back to zero. I think that for our philosophy, what we like following the best, especially for our retired clients, is Warren Buffett's rule number one in investing is don't lose money. Rule number two is don't forget rule number one. And when you can follow a rules-based system that measures the data, because we don't have a crystal ball, we don't know what's going to happen tomorrow. But when we have a rules-based system that can measure data and move in and out strategically to protect against large losses, I firmly believe that's the best route to go.
So Josh and I were talking about this, and we were talking about, maybe you get back to zero, but what if and maybe the passive investment philosophy works if you have a long time horizon. However, remember we were talking about how if somebody's taking income, right, and they're taking $1,000 a month, they automatically guarantee that loss right there. Mm-hmm. So it doesn't. So then it wouldn't make sense to do.
That wouldn't make sense to do it, and that's kind of the seductiveness of watching indexes on the news. An index on the news, no one's investing in it. There's no cost to it. There's no action going on around it, so it gives you this perfect result or this perfect illustration, but it's just an illustration. So when you're looking at the Dow, it's just an illustration of those 30 companies. Okay, did you buy those 30 companies at the same time that the Dow's being represented on the nightly news? The answer is most likely no. Yeah. And so a lot of times people look at it and get really frustrated, like, why is my portfolio not doing that? Well, that's just an illustration, okay, for lack of a better description. And so yes, what you're talking about is real life versus getting to look at an index and watch it go up and down and go, oh, I wanted to do that. Well, again, looking at it in history.
So we need to interrogate reality.
Yes. Wow, what a great idea. We'll interrogate reality. Are we doing that these days in our country? I don't know. That's a different topic. That's a different topic.
You mentioned the Dow, right?
Yeah.
A lot of times I think about our tech stocks, like Tesla and FANG, whatever it is this week. So what's going on with the NASDAQ? Why does it do?
So you don't like talking about an index that was built in 1897?
Well, it just seems to be doing whatever. The NASDAQ seems to go up when everything else goes down.
Yeah.
I just don't. It doesn't make sense when I look at the chart.
So when you look at the NASDAQ and you really look at the S&P, the effect that the tech stocks are having on the S&P. So Facebook, Apple, Amazon, Alphabet, which is Google, Netflix, throw Microsoft in there, throw Tesla in there. And the overweight that those companies have on those indexes, that they're pushing them up like a runaway freight train. It reminds me a lot of the year 2000. And that's not just looking at a chart, but I remember that in my career, that you got this idea that we will never lose. this false idea. Let me be very clear there that it's never going to go down again. Well, that's not true. Just look in history, and bubbles burst. Okay,
Right.
so we had the same type of feeling of this time it's different, and just buy the NASDAQ and buy the Qs and let it run. And so if you go back and you look at the chart of the NASDAQ in the year 2000, it peaked. Okay, and then it lost 75 to 85%, and it didn't get back to even until the year 2014.
So what was that? That's 6 years?
From 2000 to 2014.
Oh, 2000. I was thinking
You were going
way-
back. Yeah.
From
So,
14.
I mean, you think about it. If you bought the NASDAQ in the year 2000 because you bought into this time is different,
Yeah.
it took 14 years for you to make your money back. That's a hard pill to swallow. I know very few investors that would stick around for 14 years. Okay? And so when we're seeing that runaway freight train, and we look back, and every time you've seen the runaway freight train in the past,
Right.
this is what's happened. You can either say, this time's different because my gut tells me so, or this time's going to be like the last because this is what the data tells us.
Okay.
And in both cases, we can't predict the future, so we really don't know.
Right.
But I know that my gut doesn't have a lot of discipline to it, so I'm going to go with the data. You know?
No, I mean, it makes sense if it has always acted one way before.
Yeah.
So, I mean, nobody would know that they're in a bubble until after the bubble, right?
Right,
That's-
right. Well, there's some things that you can measure.
Okay.
Overbought conditions. Maybe I shouldn't have eaten the cake. There's things you can measure, kind of like the overbought conditions, the run up. You and I were talking earlier today. What's Tesla? 9x over the last 12 months, something crazy
Yeah.
like that.
I think it's, 9x.
Every time you look into something like that and you just see this on a chart, you have to be careful. I mean, especially over a short period of time, you have to go, okay, that's just a big giant warning sign to me. Just be careful. Wait for the proper time to buy into something like that.
So we've seen that swoosh everywhere, right?
You do like the Nike swoosh, yeah.
This year. So
Yeah.
if you had cash on the side,
Mhm.
when are we going in? When are we buying? What's going on?
So if you have cash on the sidelines and you're looking to invest right now, this is what I would do personally. And this is what I advise clients, that you kind of split that into two different thoughts.
Okay.
You want to stay invested. You want to get invested. I wouldn't want to just hold on to cash. No really real reason to hold on to cash for that sake, except for to maybe time a buy-in. And I say timing as a very loose term there, not real market timing.
So you don't know the top?
No, I don't. I've tried to figure it out. I thought I had it a few times, and we were wrong. But I would say that I'd go on and get invested on the bond side of the portfolio, fixed income side of the portfolio.
Right.
I'd pick a trading range based on how it's trading and try to get you to yield more to the top of the trading range. But then from a stock standpoint, I would want stocks to pull back. I would really, if you have cash, you are in a great position because you have dry powder. And you've got the ingredients for the market to pull back, get a good position to buy in for the next 10 years. That's what I would be looking for.
Okay.
I'd be very focused on data and looking for that pullback, but be patient. Charles Munger, Warren Buffett's business partner, said that the mark of a great investor is to be able to sit on his rear end. In other words, be patient. Okay? And right now is the time to be patient.
Cool.
Yeah.
Cool.
Yeah. Well, we hope you have enjoyed Coffee with Chris, and if you'd like to reach out to us, you can go to our website at www.soundfsg.com, and if you want to schedule a strategy call to have coffee with us, then we'd love to get to know you and or talk investments with you. Have a great day.